Hi ladies and gentlemen, this is Game of Trades, and this is going to be an analysis of the S&P 500. With unprecedented amounts of liquidity and some of the worst fundamentals we've seen since the Great Depression, we are bound to see some crazy moves in the markets in the coming weeks. So let's try and figure out exactly what's going to be happening in the stock market and how we're going to be able to be profitable from it. Now remember, what I highlight in this video is my own personal take on the markets, and you should by no means trade based on this video. So first of all, the recent price action we've seen in the markets is very important to understand before we can look further into what's going to be happening. We were looking for a pullback on this run up here. The markets were way overextended. We had extreme readings on the put call ratio. I covered all that in the last video. We broke the trend line. We had two targets, the 3,000 point level and the 295 level. And we did expect a bounce off one of these levels. It was highly unlikely that the markets would be able to just slice through these support levels that we created back here with this consolidation zone. And so right before hitting that 295 target, I highlighted some divergence on the hourly chart. I posted a community post I'm going to show you right now. This was the S&P 500 futures. We had a wedge pattern forming with the downtrend line and the price making a lower low with the MACD starting to run up. We had a imminent crossover on the MACD right here, and we were at very strong support. So it was really the right moment to book profits if you were short. Unfortunately, I can't make a video every time I see something on the charts, but I do try and make these community posts when I see some important developments. So if you want those in real time, you can turn on the notifications and you'll get an alert when I make a community post. So going back to the S&P 500, what does this all mean for the markets? Are we going to see lower lows in the coming weeks? And for now, I'm going to be very straight. We are not seeing the fear that I would have liked to see if the markets wanted to go further down. We had a huge red day here. This was the moment for the bears to really step in, and instead we had a huge rally to the upside. And so far the bears have not stepped in yet. Now we could still have that fear start to appear, and I'm going to discuss that later in the video, but for the time being, this price action is not particularly bearish. It could just be working off the overbought conditions. We had a huge overextended rally here. We needed that drop if the markets wanted to go higher. Now let's take a look at the facts that are going to help us to determine exactly what's going to be happening in the next few weeks. First of all, we broke the 61.8 retracement level, and I'm going to show you what I mean. If you take the fib levels from the top to the bottom, this is something I've discussed many times. We can extend it here. This was the 61.8 retracement level. You can see we bounced off of it. We reversed off of it twice here. And so all the way up until that point, we were looking for a bear market rally, because you can go back in history and all bear market rallies reverse at that 61.8 or below. So that was the maximum target for a bear market rally. So we were looking for shorts at this resistance level, but the markets broke out impulsively up above that level. So that was bullish. This is a bullish development without a doubt. When you break above a very important level, that is bullish, and that's why I was looking for a long right here, because this is a very important level. So having a bounce right here was very probable, and that's exactly what happened. Now, fact number two, and I'm going to clear the chart before. The fact that we had this breakout tells us that the Fed has a big influence on the markets. And you're probably thinking that that's obvious, that of course the Fed has an influence on the markets. Everyone knows that. But no, that's not entirely true. I'm a big advocate that when the fear enters the market for real, the Fed can only do so much. But the Fed has clearly been able to control that fear throughout this entire rally and is still able to control that fear. But as I said, for now, we're not seeing that fear settle in to the markets like we did in March. Right now, this is not a fearful price action. Fact number three, we are going to enter a phase of economic recovery, and I'm going to show you the chart that I'm talking about. This is the quarter-on-quarter GDP change in percentage. And you can see this was the 2008 recession, and this is the current recession that we're experiencing. And so these last three bars here are projections. This huge number right here is something that is already expected by the markets. This is something that has been factored in to the markets. And this is absolutely massive. When you compare that to 2008, this is very impressive. But what's very interesting about the chart is the projections. And you can see that these 2 quarters are going to be double-digit gains in GDP. And I think that's going to create a lot of hype in the markets. Now, of course, this was to be expected when you have such a big drop, 24% unprecedented drop in GDP. You're bound to have some big compensation right after. But I think in terms of news headlines, when we're going to see these numbers come out, this is really going to create a lot of hype around the V-shaped recovery in the economy. Now, fact number 4, valuations are still sky high. I'm going to show you the chart that represents that very well. This is the PE ratio of the S&P 500. I've shown this chart before, so I'm not going to talk about it too much, but it's very important to remind ourselves that we are at very high valuations, very similar to what we had in the dot-com bubble. So we are really into that bubble territory. Now, the last fact is the bearish sentiment, and I'm going to show you a chart highlighting this. This is a graph showing you that investors are still more bearish than bullish. And you can see the dark blue line is in June 2020, and only a small portion of investors think that this is a bull market or a V-shaped recovery. And if you've been trading in the stock market for a while, you'll know that that is a bullish thing. And I'm going to show you examples of that. In 2009, the moment where the sentiment was the most bearish was during this rally. This was a rally that had a lot of skepticism, and that's because the fundamentals were extremely bad at this particular moment. But the stock market never actually looked back. And if we go back to 2000, this entire period right here where we had huge moves in the market was when the sentiment was the most bullish. And you can see that was right before an actual market top. So going back to 2020, could we see a melt-up phase in the markets that takes us potentially up to the 4,000 point level? Absolutely. We have huge Federal Reserve liquidity coming right now. We're going to see an increasing amount of hype around the recovery, and we have a constant bearish sentiment where anyone that has a little common sense will be doubting the rally at each move up. And I think that's going to be a part of that fuel to take us higher. Now, of course, this is all hypothetical. If we have a second wave of the virus right now and start to slice through these levels, that's of course not going to happen. And for that to happen, we have to break those important levels. We're currently at resistance right now. The markets need to break above those highs in order to go higher. If they do manage to break above those highs, I do think there's a good chance of this scenario actually happening. Now, how high can this melt-up phase actually go? And I do think there is a limit in price and in time to how high we can go. And I'm going to compare that to the markets being on steroids. What happens when you are on steroids? You build a lot of muscle. And that's what happened during quantitative easing. I'm going to show you in 2009 all the way to 2015, we had quantitative easing. And so the markets were building gains throughout that time. And now with the recent stimulus package, the markets are now on the very strong stuff. And so the markets might start to fly very high in price. But what happens as soon as you stop, or even as soon as you get back to the old steroids that you were using? Well, that's when you're going to have a crash, when you're going to get back to the levels that you're actually supposed to be at. And I think when things are going to turn around, when the Fed is going to start cutting back on their spending, that's when things are really going to go downhill. You're going to have the stock market crashing down to normal valuations. We're going to have fear come back into the markets. We'll likely get bankruptcies because the economy will likely not be on its feet just yet. And so that's going to have a huge domino effect. At least that is my opinion. Of course, do your own research before investing or trading in the stock market. In the meantime, good luck on your trading and see you next time.